Many investors will see that it is very hard to have a return in 2015. If we look at the 5-year German Bund, you actually have to pay the German government to buy their debt because the returns are negative. This is astonishing, and we haven't seen that in recent history. Now, if we look at the investments, we believe that investors have to be very savvy this year. Our view at Bil clearly is that we are in a Goldilocks environment. It's neither too hot nor too cold. Global growth will accelerate from 3.3 to 3.7% in 2015. Now, this growth is basically driven by the growth of Western advanced economies, such as the US, essentially. Emerging markets will have a tougher time, especially the oil-producing countries, such as Russia, Brazil, Mexico, and Venezuela. Here, we might see some problems this year. If we look at Europe, clearly, we have seen a euro which came down by over 14%. Now that is very important since Europe very heavily relies on exports. It's not only the drop in the euro, but it's also the drop in the oil price by over 60% this year, which reinforces this picture. And we can clearly see the Western consumer having 100 euros more in his pocket at the end of the month, or actually also the manufacturing companies, which rely very heavily on fossil energy. And here we will see a windfall in profitability. Bring to that a Mario Draghi, which will basically expand the balance sheet of the ECB. And we have very prosperous conditions for any economic growth, both in Europe and in the US. Inflation will remain very low. We have seen a correction of the oil price, and oil is a very substantial component of any CPI basket. From that point of view, we might see a trough in Europe in the first half, and we don't expect that inflation will take back in the second half. When we look at the US, we see a slightly different picture. We see also inflation coming down, probably still remains positive, around 1% in the first half, but we will see wage pressures increasing in the second half, and with wage pressures we will have also inflation pressures. So whereas we will have inflation pressures in the US in the second half, we don't expect that at all to take place in the Eurozone. Interest rates are a tale of two halves, basically. We will see Europe, where the short end might even come further down. The long end of interest rates, because of quantitative easing, might see a spike, but then will come down again. And in the US, we might see in the second half again a rate hike on the short end. And in the long end, this depends about inflation. Now, we are positive on inflation. So overall, we expect actually also the long end to move quite dramatically in the second half in the US. Monetary policies are very accommodative. Central banks continue probably to pump another $1 trillion this year into the economies. Now, what we are concerned about is that they are too obsessed with inflation. Inflation is actually backwards looking. So we like the central banks to be not behind the curve, but ahead of this. From an investment point of view, risk assets continue very strongly to benefit from this support by the central banks. So what does this all mean for investors and the investment policy? On the one side, we have global growth accelerating, so it's actually not too hot. And on the other side, we have inflation being low, but we don't fall in this deflationary spiral, so it's not too cold as well. So we remain overweight risk assets, such as equities, and we look for those equities where valuations are very appealing. This is true for Japan and for Europe, less for the US. In terms of credits, we like very much European investment credits. We see a further potential for tightening, whereas in the US, we don't see that. We are less bullish on emerging market equities and fixed income because the cost of capital will go up with the rising US dollar. Last but not least, we remain positive on the US dollar, less so for the euro, and we are negative on the British pound, simply because the election in May will lead Britain into a very difficult discussion whether they should stay in the Eurozone or not. So overall, we believe this is a Goldilocks environment, not too hot and not too cold.